Should you be changing your investment strategy based on what the outcome of the US election next week is going to be? My name's Mark Walhout, and I'm going to walk you through some of the reasons why I don't think that the outcome of the presidential election should impact your investment decisions. So the first reason is that there's not a lot of signal in US stock returns between things that happen in the market during an election year and things that are happening in the market after the election. So if your question was, should I be changing my investment strategy now as we approach the election, hoping that the markets will be different, either better or worse in the year after the election? And there's not a ton of signal in that data. Going back to 1926, the average return of the US stock market in an election year was 9.9% per year, and the average return of the US stock market after an election year is 11.3% per year. And I'm going to put a SlideShare in the notes below this video so you can see the skewness, the noisiness of the data set. Just give you an idea that there's not a lot of signal there. So if your decision was, hey, I'm going to get out of the market now and I'm going to get back in, once the election's passed, or vice versa, it's just not really a great strategy. And the second major reason is that regardless of whether the president is a Republican or they're a Democrat, there's lots of noise in the data around returns for different political parties being in power. And I'll give you an example. So in George W. Bush's presidency, he came in as a very conservative, free market Republican president. During his presidency, the average annualized return of the S&P 500 was negative 4.4% over his 2 terms. Barack Obama came in as a more progressive Democrat, and there was concern is this going to be really devastating for the markets if Obama becomes a president, or is he going to raise taxes? And in reality, what happened was that when Obama was the president, the US markets returned average 16% per year annualized with no down years. And so that you want to be careful with that too, because that's not in and of itself its own signal. It's not that Democratic presidents deliver outsized returns during their presidencies and there was something wrong with the Republicans or George W. Bush that created negative returns. If you remember, there was just a lot more going on in the world during those times. So George W. Bush came in 2000, 2001 in the depths of a recession in the United States. There was a dot-com implosion. Then when he left office, George W. Bush, they were in the depths of the financial crisis, the great financial crisis. Obama took over in office during the financial crisis, and there was a tremendous amount of recovery in the U.S. stock market that carried through all the way up into the beginning of this year. So I guess the point is that shareholders ultimately are invested in companies. They're not invested in U.S. presidents. And the second major takeaway is that presidents are really only one factor. Political parties are really only one factor in what makes the prices of stocks and bonds move around the world. Other factors include innovation, health crises like we're having this year, interest rates, commodity prices. There's tons of other factors that go into what happens with stock and bond returns. So looking at an election, trying to make decisions about your long-term investment plan based solely on the outcome of the election, to me doesn't really seem like a great idea. And historically, the data has shown that it's not really a great idea to be making decisions based on what you think is going to happen with the election. So I hope you found this interesting. I hope you find that the slides below give you some more insight to the impact of presidents on markets. And I hope you have a fantastic day. Take care.